It's almost that gold, rather than being a beneficiary of inflation, is actually suffering. It's a casualty of inflation. Higher inflation, paradoxically, is actually bad for gold. Gold's failure to deliver on the promise or the expectations, probably, that a lot of people had who currently own gold, or maybe more importantly, people who own gold stocks who were anticipating a gold rally. And one of the reasons that a lot of people own gold is inflation. We're buying gold as a hedge against inflation. And now we've seen some of the worst inflation numbers we've really seen since the early 1980s, or the 1970s. Yet the price of gold is kind of hovering around 1800, a little bit below as I'm speaking. And gold stocks have actually been among the worst performers. In fact, technically, in bear markets, having to pull back at least 20% from their recent highs. In fact, if you look at many of the stocks like the GDXJ, which is an index of junior gold mining stocks, that index has been making 52-week lows, although it's not at a 52-week low today, but it has been hitting those lows, despite the fact that those of us who were betting on more inflation bet right. We have more inflation. It's just that if you place that bet through gold stocks, so far you haven't been paid. And the reason for that, I think, is a bit ironic. If we still measured inflation today the way we measured it back then, the number would be much worse. I mean, just take, for example, rent. If we actually used real rents, the rents that people are paying, versus what the government pretends that people pay when they use owner's equivalent rent, which we use today, but which wasn't in use in the early 1980s, we would have an annual inflation rate right now north of 10%. In fact, it's possible that the last 12 months have seen a bigger increase in consumer prices than in any year during the 1970s. But the point is that the inflation that the government will admit to today is already 50% higher than what was so bad in the early 1970s that it caused Richard Nixon to panic and go for wage and price controls. So what was an alarming rate of inflation in the early 1970s is now being brushed aside today, not only by the Federal Reserve, but also by investors. Investors don't believe that the high inflation numbers that we're seeing today are sustainable. Everybody thinks that this is a transitory increase in consumer prices, not a permanent increase, and therefore they're not motivated to move into an inflation hedge, because you don't need to hedge transitory inflation. And in fact, if inflation is not transitory on its own, the markets expect that the Fed will make the inflation transitory, because Fed officials have repeatedly assured the markets with words that they will do that they have the tools to somehow make sure that inflation stays anchored at 2%, even though they're going to allow it to slightly exceed 2% in the short term. Over the long run, they are determined, and they are going to use their tools to make sure that inflation stays at around 2%. And it's the anticipation of using those tools that is weighing so heavily on gold and on gold mining stocks. And what happens when the Fed is tightening monetary policy? Well, that's supposedly good for the dollar and bearish for gold. And if it's bearish for gold, it's even more bearish for gold stocks, which represent the present value of their future earnings. And if you expect gold prices to be even lower in the future than it is now due to the Fed tightening, well, you would see that in today's gold price, in today's gold stock price, even if you wouldn't see it in today's gold price, because the stocks are forward looking, whereas the spot gold price is not. It's just looking at what is the price today. But why do people believe Fed policy is going to be so dollar supportive? Why do they think it is going to hurt gold? Well, because traditionally, that's what happens when the Fed tightens. And so everybody assumes that this tightening cycle will be the same as all the prior tightening cycles without recognizing the huge difference between this cycle and the ones in the past. Because it's possible that this cycle will consist entirely of talk. It may not consist at all of action. But even if we do begin to tighten, the way that tightening is going to be rolled out is going to be simply through a reduction of the amount of quantitative easing that the Federal Reserve is currently doing. And they're referring to this reduction as a taper. And it's all this taper talk that has been talking down the price of gold and therefore gold stocks and helping to talk up the dollar. But if you understand what the Fed is actually talking about doing, they're not talking about shrinking the money supply. They're not talking about reducing the size of their balance sheet. They're simply talking about increasing their balance sheet at a slower pace in the future than they're increasing it now. In other words, the Fed is not talking about putting out a fire. The Fed is talking about putting less kindling on the fire or throwing less gasoline on the fire. And it's tight money that historically has been bullish for the dollar and bearish for gold. What you would need to have an environment that is negative for gold would be high real interest rates, not negative interest rates that are less negative. But the reality is interest rates are likely to go more negative because the 6% inflation that we're experiencing now is not the ceiling, it's more likely the floor. We're going higher from here because the Fed is doing nothing to actually fight inflation. Simply talking about tapering and even tapering your QE program is not going to fight that kind of inflation. And so I think that everybody who is selling gold or selling gold stocks because they assume that what we're going to experience is a normal tightening cycle still doesn't get the bind that the Fed is in, and they still haven't figured out the way this game works, because whenever the Fed tightens, whether it actually tightens or just pretends to tighten, but the minute they start doing that, they sow the seeds for the next easing cycle. And each tightening cycle becomes smaller and smaller, and each easing cycle becomes bigger and bigger. The Fed cannot fight this inflation. The markets have got that wrong. In fact, I don't even think the Fed is going to try to fight it. I think the Fed knows that if it fights inflation, it's going to lose. So it's not even going to fight. Now, it will bluff. It will talk a good game. So it never actually has to get in the ring and get knocked out. So it's going to pretend that it's got these tools and it's going to use them, but it can't use them. And so then the people who are investing in gold stocks, instead of pricing gold stocks to reflect a lower gold price in the future, maybe people are assuming gold's going to go down to 1,500 or 1,200. I don't know where they think it's going to go. But when they have to start looking at these stocks through a whole new prism of, hey, gold's going higher. It's going to go to 2,000. It's going to go to 3,000. It's going to go to 5,000. That means the profits of these gold mining stocks are going to soar. And in fact, if you look at gold mining stocks right now, they're already trading. The major gold mining stocks are trading at a discount to the S&P. They're actually on a lower price earnings ratio than the S&P, even though historically they trade at a big premium. And once you actually get this big increase in gold prices, those PEs collapse unless the prices really go up. And some of the gold stocks are already paying pretty decent dividends now, and those dividends are going to end up much, much higher once the gold price rises and their profits rise. I think the best way, again, to profit from the fact that gold hasn't rallied yet and that these gold stocks reflect fantasy, not reality. They reflect the fact that so many traders don't understand the predicament that the Federal Reserve is currently in.